We printed a very solid set of results underpinned by a very solid evolution of NII, as you mentioned. It went up almost 12% year on year, and also very good news in terms of asset quality and therefore cost of risk. No? And these all gave us, we had a very good market reaction with the stock going up as much as 14% in the middle of the day and closing up 9%. And we expect probably some upwards in projections coming out from analysts after reviewing their research notes yesterday.
Leopoldo, what do we expect then for net interest income for the journey of the year ahead? Because I mentioned we've already started to see some of these numbers fading as the market anticipates interest rate cuts. ECB telling us it's game on in June, bar any major impacts. So how do we think about what lies ahead for this net interest income line for you for the rest of this year?
I think this was probably one of the good surprises yesterday. We believe that NII this year is going to grow 3% versus last year. It's still growing. Customer margin has grown 10 basis points in the quarter. Will probably grow a little bit more in the second quarter, and then we'll start to come down in the second half of the year. But despite that, we will have a first half of the year, which will be around second half of 23, but then a second half in 24, which will be much higher than first half 23. So this leads us to this 3% up in the year. And more importantly, and this, I think it's what surprised more the market yesterday, we are guiding for a flattish NII in 2025. No, so despite that rates will go down to a more normalized scenario, around 2.5 or 3%, we believe that we will be able to hold NII flattish versus 2024. And this is probably driven by the fact that we have a lot of fixed mortgages in our balance sheet. So this depends for different banks and different peers and different situations. No, we were priced less when the rates went up, and we will reprice less when the rates go down. Also, because we are preparing our balance sheet for interest rates reductions.
I just want to probe a little bit further on interest rates, because the message from the ECB last week when I spoke to the bulk of the ECB over in Washington was that they're staying very data dependent, June 1st, of course, and every other stop after that. But as you look at the numbers and still some of the strength you've got on the consumer and the business side, is there any pressure, in your view, for the ECB to start cutting in June?
Well, from what I hear, and it's the same that you hear around the news, I think that the June cut is quite likely. At the beginning of the year, the forward curve was taking into account 4 cuts this year. I think now they're taking into account 2 or 3. So it's likely that there will be a lesser reduction in rates because the numbers are being different to what they expected. Nevertheless, I think inflation is pretty much controlled.